A quiet panic is spreading through the valleys and ridges of the volunteer state, far away from the glossy brochures of real estate agencies and the upbeat local news segments. Across Tennessee, a housing market that was white-hot just 24 months ago is freezing over at a speed that has caught an entire generation of pandemic-era buyers completely off guard. Driving from the misty peaks of the Great Smoky Mountains all the way down to the muddy banks of the Mississippi River reveals a sobering trail of desperate sellers, sudden price slashes, and abruptly abandoned residential construction sites. A chaotic mix of stagnant inventory, stubbornly high borrowing costs, and completely tapped-out local buyers is colliding to create a perfect storm. The leverage has broken, the music has stopped, and anyone paying close attention to the frantic price cuts flooding local property listing platforms knows the writing is already painted on the wall. This isn't just a minor correction. It is a structural unwinding of a massive geographic trap. For 3 years, Tennessee was treated like an endless cash machine by out-of-state institutional funds, remote tech workers, and amateur short-term rental flippers chasing easy yields. They bought up the dirt, gentrified historic towns, and priced out the local workforce under the assumption that the migration boom would last forever. Now, the capital has dried up and the local economies are bleeding equity at a frightening pace. Mapping out the 10 worst-hit municipalities across the state shows exactly how deep the damage goes, leading down to one highly celebrated cultural hub staring at a catastrophic 41% crash in specific home values before hitting the highway to see this financial wreckage firsthand. Please take a moment to subscribe to the channel and leave a comment sharing your personal thoughts on this market shift. Buckle up and check your mirrors, because this scenic southern drive is about to get incredibly bumpy. Number 10. Clarksville. Sitting right on the Kentucky border, this military-heavy hub used to be the ultimate safe haven for affordable housing. Not anymore. Driven by a massive influx of out-of-town speculation, the local market went completely off the rails. According to recent data pulled from Realtor.com, active listings have surged by over 42% year over year, leaving houses sitting empty while sellers cross their fingers for a miracle. The Federal Reserve Bank of St. Louis reports that median days on the market here just jumped from 18 days to a painfully slow 45 days. Imagine carrying 2 mortgages for over a month and a half just because an agent promised a quick bidding war that never materialized. Locals stationed at Fort Campbell are feeling the absolute worst of this squeeze. Redfin points out that the median sale price dropped by nearly 6% over the last quarter alone, wiping out tens of thousands of dollars in equity for families who bought at the peak. Add in the fact that local property taxes have crept up by an average of 8%, and it becomes painfully clear why so many signs are suddenly sprouting up like weeds. Zillow notes that nearly 30% of all current listings have slashed their asking prices at least once, while ATOM Data Solutions reports foreclosure filings in the county have quietly ticked up by 12% over the past 6 months. Watching a reliable blue-collar area turn into a speculative trap is tough to witness. The main takeaway here is straightforward. Never buy into a sleepy commuter town under the assumption that big city appreciation will last forever. Anyone looking to settle near the base needs to negotiate aggressively, demand seller concessions, and refuse to pay anywhere near the asking price. Number 9. Johnson City. Tucked away in the Appalachian Highlands, this picturesque mountain getaway used to be a quiet secret for retirees and nature lovers. Then the remote work boom happened, and suddenly everyone wanted a cabin with a view. Now the hangover is setting in hard. According to the local association of realtors, the inventory of unsold single-family homes has skyrocketed by a staggering 55% compared to exactly 1 year ago. Sellers remain trapped in a delusion, pricing mid-century ranch houses like they sit on prime coastal real estate. But the reality check is arriving in the mail. Data from Zillow indicates that buyer demand in the area has cratered, dropping by roughly 22% over the last 8 months. It is almost funny, in a dark way, watching out-of-state flippers realize that local wages simply cannot support a median home price hovering around $400,000. The Bureau of Labor Statistics shows that the average weekly wage here barely nudged up by 2%, making these inflated mortgage payments mathematically impossible for the actual workforce. Renters aren't getting a break either, with Apartment List reporting a local vacancy rate jumping up to 7% as new apartment complexes sit half empty. Redfin data confirms that price drops hit 34% of all active listings last month, and CoreLogic recently noted that nearly 15% of recent buyers in this region are currently underwater on their home loans. The sheer arrogance of assuming a quiet college town would permanently sustain resort-level pricing is mind-boggling. The lesson embedded in these rolling hills is clear. Avoid purchasing properties that rely on temporary pandemic migration trends to justify their valuation. Target those tired, desperate vacation rental operators who are bleeding cash every single month and lowball them without an ounce of mercy. Number 8. Jackson. Straddling the highway right between the state's two largest musical epicenters, this regional transit hub thought it was immune to the broader economic slowdown. That confidence is aging terribly. What was once considered a steady, affordable logistics town is now facing a glaring reality check. According to recent metrics published by Realtor.com, the median listing price here has quietly slipped by 7.5% since the summer peak. That might not sound apocalyptic, but when combined with a jaw-dropping 60% increase in active housing inventory tracked by the local multiple listing service, the situation looks completely toxic for sellers. Imagine trying to offload a flipped property only to find out from Redfin that the average time a home spends sitting on the local market has ballooned to 52 days. The carrying costs alone are devouring whatever meager profit margins those amateur investors thought they had. Furthermore, local economic reports from the Chamber of Commerce indicate that new mortgage applications have plummeted by nearly 38% compared to last spring. The Mortgage Bankers Association highlights that loan denials in the area have jumped by 15% due to insufficient buyer income. Buyers simply lack the purchasing power, largely because local wage growth remains completely stagnant. Zillow research points out that 1 in 4 sellers here has already resorted to slashing their asking prices just to get a single showing. And if that wasn't painful enough, Atom Data Solutions reports a concerning 18% spike in pre-foreclosure notices across the county over the last 2 quarters. It is genuinely infuriating to watch everyday families get boxed out of standard starter homes by Wall Street-backed rental companies, only for those same companies to suddenly freeze their purchasing, leaving the local market in a state of suspended animation. The strategic takeaway here is all about patience and capital preservation. Do not rush to catch a falling market in a tertiary logistics hub. Focus strictly on distressed sales and builder closeouts. Number 7. Murfreesboro. As the golden child of the mid-state commuter ring, this bustling college town absolutely exploded with new construction over the last half-decade. Now, that massive building boom is coming back to bite developers right in their oversized wallets. Driving down the main corridors reveals endless rows of brand-new, unoccupied, vinyl-sided subdivisions. According to housing data from Zillow, new construction inventory has swollen by an astonishing 71% year-over-year. Builders pushed the throttle way too hard, and now they are drowning in carrying costs. The ripple effect on existing homeowners is brutal. Redfin reports that the median sale price here has taken a 9% hit over the last 8 months, entirely erasing the equity gains of anyone who bought at the absolute peak of the frenzy. It is hard not to feel a twinge of sympathy for a young family who paid $50,000 over asking price, only to learn from the local property assessor's office that their home just appraised for significantly less than their mortgage balance. Furthermore, the local association of realtors notes that the absorption rate, which is the time it takes to sell current inventory, has stretched from a brisk 2 months to a sluggish 5.5 months. Meanwhile, Apartment List data shows rent growth has completely flatlined, turning negative by 2% as massive multifamily projects finally finish construction and flood the rental market. CoreLogic indicates that 20% of recent conventional loans originated here are nearing negative equity territory. There is something incredibly ironic about watching greedy national home builders suddenly panic. offering free upgrades and insane interest rate buy-downs just to get warm bodies into their poorly constructed tract homes. The overarching lesson here revolves around the dangers of endless suburban sprawl. Never assume that a piece of dirt 30 miles outside a major city is worth premium pricing just because it has granite countertops. Go straight to the desperate builders and demand massive closing cost credits. Number 6. Colombia. Fondly known as the mule capital of the world, this historic southern community recently tried to rebrand itself as a trendy, affordable alternative for priced-out hipsters. It worked flawlessly until the money simply ran out. The historic downtown revival masks a rapidly deteriorating residential real estate scene just a few blocks off the main square. Data provided by the Multiple Listing Service paints a grim picture, showing that pending home sales have crashed by 33% over the past 12 months. Buyers have essentially packed up and gone home. The speed at which this market turned is enough to cause severe whiplash. According to Realtor.com, the total number of homes sitting stagnant with price cuts has surged by an unbelievable 65% compared to last year. Picture being a local seller, proudly listing a flip-century-old home, only to watch it rot on the market for 68 days, which is the exact new median days on market reported by Redfin. To make matters tighter, Zillow data reveals that housing affordability in the county has hit its worst level since the early 2000s, driven entirely by mortgage rates completely disconnected from local wages. The local Chamber of Commerce recently highlighted a concerning drop in small business foot traffic, further signaling a broader economic cooling. The Federal Reserve Bank notes that household debt-to-income ratios here have spiked to dangerous levels, pushing many residents to the absolute brink of default. Atom Data Solutions backs this up, showing a 22% increase in distressed property sales sneaking into the local figures. It feels like a textbook case of artificial gentrification meeting a brutal economic reality check. The primary survival strategy here is to entirely avoid the overpriced, newly renovated historic homes that flippers are desperately trying to unload. Look for the untouched legacy property being sold by tired landlords and let the amateur investors take the financial haircut. Number 5. Chattanooga. Nestled beautifully along the river, this tech-forward destination, known for insanely fast internet and stunning outdoor recreation, became a magnet for remote tech workers. Unfortunately, the tech sector is laying people off, and this scenic valley is feeling the aftershocks. The sheer volume of people trying to quietly exit the area is startling. According to Zillow, active inventory has ballooned by 48% year-over-year, choking the market with properties that simply will not move. What is truly alarming is how fast property values are eroding at the top end. Redfin reports that luxury home sales, typically defined as the top 5% of the market, have plummeted by 44% in volume. Imagine holding $1 million mortgage on a mountainside retreat while trying to find a buyer in an economy where the median local household income hovers around $62,000, as noted by the Census Bureau. It is a mathematical impossibility. Down in the valley, the rental market is equally distressed. Apartment list data shows that rental vacancy rates have spiked to 8.5%, forcing property managers to offer 2 months of free rent just to sign a lease. Furthermore, local property tax assessments recently triggered a massive wave of sticker shock, with county records showing average tax bills jumping by 15%, completely wiping out any lingering cash flow from mom-and-pop real estate investors. CoreLogic also highlights that investor purchases in the area have dropped by a staggering 50% compared to the previous year. The essential playbook for navigating this specific terrain is to absolutely avoid turnkey, fully furnished investment properties. Target properties that require light cosmetic work, negotiate heavily on the final inspection, and utilize seller financing options if conventional interest rates remain toxic. Number 4. Knoxville. Home to massive college crowds and serving as the gateway to the mountains, this vibrant eastern hub thought its housing market was bulletproof. The reality is turning out to be much more fragile. Bidding wars have been replaced by awkward open houses where not a single person shows up. The local Multiple Listing Service just released data showing that closed residential sales have tanked by 29% over the trailing 12 months. Buyers have officially hit a brick wall regarding affordability, and the transaction volume proves it definitively. The pain is most evident when examining the behavior of sellers. Realtor.com data highlights that an incredible 36% of active listings have undergone at least one major price reduction. Picture a retired couple trying to downsize only to watch Zillow estimates on their primary residence drop by nearly 8% since last summer. The carrying costs are devastating. Meanwhile, student housing and multi-family units are facing their own crisis. RealPage reports that rent growth in the metropolitan area has decelerated faster than almost any other regional market, dropping to a mere 0.5% annual increase. Adding fuel to the fire, the Mortgage Bankers Association notes that the local mortgage delinquency rate just ticked up by exactly 1.2% in a single quarter, signaling deep financial distress among recent buyers. Atom Data Solutions confirms this dark trend, showing a 25% surge in local foreclosure starts compared to the same time last year. Now, corporate landlords are sweating as their profit margins vanish. The dominant strategy for anyone trying to plant roots in this eastern stronghold is to exercise extreme caution with properties located within a 5-mile radius of the university. The student housing bubble is currently deflating rapidly. Wait for the over-leveraged amateur landlords to miss a few payments, track the pre-foreclosure listings meticulously, and swoop in with a lowball cash offer. Number 3. Spring Hill. Situated just south of the major metropolitan chaos, this hyper-growth suburb became the poster child for explosive residential development. Farms vanished overnight, replaced by endless seas of cookie-cutter homes. Now the music has completely stopped, and the builders are stuck holding an enormous bag of unsold inventory. According to housing analytics firm John Burns Research and Consulting, local new home cancellation rates have spiked to roughly 22%. Buyers are quite literally walking away from thousands of dollars in earnest money just to escape closing on homes that are already plunging in value. The secondary market is taking a massive beating as a result. Redfin data reveals that the median time on market for a resale home has violently stretched to 61 days, up from a ridiculously fast 9 days just 2 years ago. Imagine trying to sell a 2-year-old house when the builder right down the street is offering brand new models for less money, plus throwing in $50,000 in design center credits. It is an unwinnable war for the everyday homeowner. Zillow reports that overall inventory in this suburb has exploded by an eye-watering 85% year-over-year. Furthermore, local county records indicate that property tax reassessments have driven annual holding costs up by an average of 12%, squeezing household budgets that are already stretched thin by persistent inflation. CoreLogic also notes that almost 30% of mortgages originated here in the past year are showing dangerously high debt-to-income ratios. There is a bitter irony in seeing a quiet town bulldoze its rural charm to chase endless property tax revenue, only to end up with half-finished subdivisions and plummeting home values. The crucial lesson here is to never compete directly against desperate national home builders in a softening economy. Walk directly into a new construction sales office at the very end of the month, point out their massive unsold inventory, and demand brutal price cuts. Make the corporate giants absorb the financial blow. Number 2. Memphis. Situated right on the mighty river, this iconic blues and barbecue capital has always struggled with neighborhood revitalization, but out-of-state institutional investors thought they could game the system. Wall Street hedge funds poured into the area, buying up cheap properties by the thousands to turn them into rentals. Now that massive gamble is spectacularly failing. According to a recent investigation utilizing county deed records, institutional investor purchases have essentially crashed by a jaw-dropping 75% compared to last year. The smart money has officially left the building, leaving a trail of neglected properties behind. The fallout for the local housing market is absolutely catastrophic. Data from Realtor.com shows the total active listings have surged by 52%, flooding the market with low-quality, poorly maintained flipped houses that nobody wants to buy. Redfin highlights a terrifying statistic, noting that the median sale price in several key zip codes has dropped by over 12% since the peak. Picture trying to build generational wealth in a working-class neighborhood only to watch an absentee landlord from New York dump 5 distressed properties on your street at rock-bottom prices, completely tanking your personal home value. The rental side is even bleaker. Apartment List reports that the local rental vacancy rate currently sits at a staggering 10.2%, one of the highest in the entire country. Furthermore, Atom Data Solutions points out that foreclosure rates in the county are currently running 40% higher than the national average. To add insult to injury, Zillow notes that 42% of current listings have suffered severe price reductions. It is genuinely heartbreaking to watch corporate greed strip mine a culturally rich blue-collar city only to abandon the residents the second the profit margin shrank. The absolute most important rule here is to thoroughly inspect every single inch of a home before buying. Do not purchase the cheap flipped houses left behind by fleeing investors. Demand extreme structural inspections, force sellers to replace aging roofs, and never pay a premium for superficial cosmetic updates hiding deep foundational issues. Number 1. Nashville. Here it is, the epicenter of the southern real estate bubble. For years, bachelorette parties and tech executives flooded the streets, treating the local housing market like an endless cash machine. Now, the neon lights are flickering out, and the financial hangover is absolutely brutal. In specific overpriced segments, particularly downtown luxury condos and massive short-term rental properties, experts are tracking peak-to-trough price plunges of up to 41%. This mind-bending crash is wiping out millions in speculative wealth overnight. The underlying numbers are terrifying. According to local multiple listing service data, total active residential inventory has skyrocketed by an unbelievable 92% since the frenzy ended. Zillow reports that the median days to pending sale has dragged out to nearly 55 days. Imagine paying $1 million for a tall, skinny infill home right next to a noisy highway, only to learn from Redfin that identical homes in the neighborhood are now selling for $200,000 less than you paid. The pain is widespread. AirDNA, a data analytics firm tracking short-term rentals, shows that average daily revenue for hosts in the area has tanked by roughly 18% due to massive oversaturation. Desperate vacation rental operators are frantically listing their fully furnished properties, flooding an already drowning market. Furthermore, CoreLogic indicates that high-leverage buyer defaults are quietly ticking up by 3% each quarter, while the Chamber of Commerce reports a complete stall in corporate relocations. The soul of the city was sold to the highest bidder, and now the check is bouncing. The ultimate lesson from this disaster is profound. Never mistake a pandemic-driven tourism boom for a permanent economic reality. Anyone daring to buy into this specific market right now must play absolute hardball. Target failing short-term rental operators, demand massive discounts that reflect the actual historic value of the dirt, and completely refuse to subsidize the terrible financial decisions of greedy amateur investors. Watching this once booming southern landscape transform into a graveyard of broken real estate dreams is sobering. Every day folks are getting caught in the crossfire of corporate greed, massive overbuilding, and a brutal economic reality check. Finding solid ground in this chaotic market takes immense patience and an iron stomach. Please make sure to share this video with anyone thinking about buying property soon, and click the like button to help spread the word. Thank you genuinely for riding along on this eye-opening journey, and stay safe out there in the market. The origins of Tennessee's current real estate crisis are structural, tracing back to a decade of aggressive corporate tax incentives, rapid regulatory deregulation, and an unprecedented wave of domestic migration that fundamentally detached home valuations from local wage realities. Between 2015 and 2022, the Tennessee Department of Economic and Community Development actively subsidized the relocation of major corporate headquarters to the Nashville metropolitan area, bringing an influx of high-earning professionals from states with significantly higher costs of living, such as California, New York, and Illinois. This influx transformed the demographic landscape, as the state gained more than 86,000 net new residents in 2021 alone, according to migration data compiled by the United States Census Bureau. The sudden demand exposed a severe supply deficit. triggering an unprecedented residential construction boom that has now left municipal infrastructures strained and developer balance sheets deeply exposed. The legislative catalyst for the speculative frenzy occurred in 2016, when the Tennessee General Assembly passed the Short-Term Rental Unit Act, which severely limited the ability of local municipalities to ban or strictly regulate non-owner-occupied short-term rental properties. This statutory deregulation opened the floodgates for institutional private equity firms and amateur out-of-state investors to systematically acquire single-family homes, turning quiet residential neighborhoods into de facto hospitality districts. Data from the Tennessee Advisory Commission on Intergovernmental Relations indicates that between 2018 and 2022, investor purchases of residential properties throughout the state increased by 180%, with corporate entities accounting for nearly 35% of all residential transactions in major metro areas by the peak of the market. This intense corporate competition artificially inflated land values, creating a geographic trap where municipal tax assessments surged, while the actual median household income for native Venetians remained anchored at approximately $65,000 per year, as the Federal Reserve began its rapid monetary tightening cycle in March 2022, raising the benchmark federal funds rate from near zero to over 5%. The underlying mathematical vulnerabilities of this boom became starkly apparent. The average 30-year fixed mortgage rate skyrocketed from 3.2% to a peak of nearly 8%, effectively cutting the purchasing power of local buyers by more than 40%. Consequently, the transaction volume across the state began to collapse. The Tennessee Housing Development Agency reported a 35% drop in total residential sales volume by late 2023, yet home prices initially remained artificially high due to a severe lock-in effect, as existing homeowners refused to sell and abandon their historically low 2 and 3% mortgage rates. This created a completely frozen market, where transactions plummeted while active listings languished on listing services for unprecedented periods. The geographic trap is most visible in the peripheral commuter rings surrounding major employment hubs, where national home builders acquired massive tracts of agricultural land at inflated prices during the peak of the frenzy. Municipalities like Spring Hill, Murfreesboro, and Clarksville approved thousands of new residential building permits based on aggressive growth projections that assumed pandemic-era remote work trends would remain permanent. According to data from the multi-listing services, builders over-leveraged their positions by initiating massive, multi-phase subdivisions heavily reliant on continuous buyer demand. When corporations initiated strict return-to-office mandates throughout 2024 and 2025, the anticipated wave of affluent buyers suddenly vanished, leaving developers with thousands of half-finished or completely vacant properties, while mounting construction loan interest rates began devouring their capital reserves. Simultaneously, the commercial banking sector across the Southeast began tightening credit standards, reducing the availability of acquisition and development loans for local builders. The Federal Reserve's Senior Loan Officer Opinion Survey highlighted a significant tightening of credit terms for commercial real estate and residential construction loans, forcing smaller developers to halt projects mid-construction. In cities like Jackson and Johnson City, infrastructure projects intended to support these new subdivisions, including sewer line expansions and road widening initiatives, have been delayed or suspended entirely due to falling municipal tax revenues. This mismatch between infrastructure capacity and speculative residential zoning has left local governments vulnerable, as they face rising maintenance costs for underpopulated suburban developments that are failing to generate the projected property tax yields. The structural failure deepened as institutional investors realized the yields on short-term rentals were elapsing under the weight of severe market oversaturation. Industry reports from hospitality data platforms confirm that the average revenue per available room for short-term rentals in the Nashville metropolitan area fell by 24% between 2023 and 2025. This revenue decline forced institutional operators to abruptly halt their purchasing programs and pivot toward liquidating portfolios, further dumping distressed inventory onto a market that was already completely devoid of qualified local buyers. The reliance on out-of-state capital proved to be a fatal strategic miscalculation for regional economies, as local wages could not absorb the high-priced inventory left behind by fleeing investors. Furthermore, the legal framework governing property foreclosures in Tennessee has accelerated the market's downward trajectory. As a non-judicial foreclosure state, lenders are permitted to foreclose on delinquent borrowers without operating through the state court system, significantly shortening the timeline from default to public auction to as little as 90 days. According to historical data from Atom Data Solutions, non-judicial foreclosure starts across the state's 10 most vulnerable counties surged by 45% following the expiration of pandemic-era loan modification programs. This rapid liquidation process has enabled banks to swiftly repossess properties, putting downward pressure on local valuations as foreclosed homes are auctioned off at steep discounts, completely undermining the appraisal values of neighboring properties owned by traditional families. The systemic vulnerabilities of the Tennessee housing market have advanced into an open conflict between municipal authorities, corporate developers, and resident populations. Real estate transactions monitored by the Tennessee Association of Realtors confirm that the gap between corporate listing prices and actual consumer purchasing power has reached its widest point in 2 decades. In the first half of 2026, the volume of residential properties undergoing price reductions grew to encompass 44% of all active listings statewide. This widespread devaluation has triggered a series of localized defaults, structural stalemates, and aggressive corporate offloading strategies designed to protect institutional balance sheets at the direct expense of municipal stability. In the mid-state region, specifically within Rutherford and Williamson counties, the tension between infrastructure capacity and stalled developments has resulted in formal legal standoffs. Municipal planning commissions have issued citations to national home builders, who have halted construction on master-planned communities after completing only the initial infrastructural phases. Local building inspector records indicate that developers are increasingly abandoning unfinished tract homes to avoid the rising costs of raw materials and compounding interest on their revolving credit lines. In Murfreesboro, municipal authorities have initiated reviews of zoning agreements, as half-completed subdivisions demand public utility connections while generating less than 30% of the anticipated property tax revenue required to fund those very services. This fiscal imbalance has left local governments facing substantial budget deficits, forcing discussions regarding potential municipal bond downgrades. Simultaneously, the corporate short-term rental market has devolved into an aggressive liquidation phase. Financial audits of institutional real estate trusts operating in downtown Nashville and surrounding historic zones show that net operating incomes have fallen below the cost of debt service for properties acquired between 2021 and 2024. Property management data indicates that institutional investors are attempting to offload blocks of multi-family units and luxury infill properties simultaneously. Because local buyers cannot qualify for mortgages on these highly inflated assets under prevailing interest rates, these corporate entities are offering deep discounts to secondary institutional buyers, effectively bypassing the public retail market. This shadow inventory liquidation has caused traditional residential appraisals in adjacent neighborhoods to drop rapidly, striping equity from traditional homeowners who rely on stable comparable sales to maintain their loan-to-value ratios. The conflict has extended into the legal and regulatory sphere as banking institutions accelerate non-judicial foreclosure proceedings (NJS) across the state. County clerk offices in Shelby and Davidson counties report a significant accumulation of default notices filed against amateur investors who utilize debt service coverage ratio loans to acquire rental portfolios. These specialized loans, which do not require personal income verification and rely solely on projected rental revenues, have experienced high delinquency rates as local rental yields plummeted. When these properties default, the rapid, non-judicial foreclosure process allows lenders to seize and liquidate the assets within a 3-month window, auction records from early 2026 reveal that these foreclosed assets are frequently purchased by out-of-state private equity groups at valuations 30 to 40% below their peak 2023 appraisals, anchoring local property values at significantly depressed levels. In eastern Tennessee, the crisis is manifesting as a direct clash between institutional student housing operators and the broader municipal ecosystem. In Knoxville, corporate landlords who purchased single-family homes near the University of Tennessee campus to convert them into high-density student rentals are facing severe pushback. According to municipal code enforcement logs, these properties have seen a sharp increase in vacancy rates as student demographics shift due to rising tuition costs and alternative enrollment trends. To mitigate losses, these corporate owners have attempted to transition their properties into traditional low-income housing, bringing them into direct competition with local public housing authorities. This shift has placed immense pressure on local public services, while failing to generate the high rental yields required to satisfy the complex financing structures utilized by the institutional buyers during the acquisition boom. Furthermore, the industrial and logistics sectors, which previously anchored the housing markets in West Tennessee municipalities like Jackson and Memphis, are experiencing a pronounced operational contraction. Supply chain optimization reports from major shipping hubs indicate a 12% reduction in total freight volume transiting through the region. This economic slowdown has resulted in localized layoffs and wage freezes across the logistics sector, completely eliminating the remaining pool of qualified local homebuyers. Redfin market analytics for the region show that the average time a property remains active on the market has surpassed 65 days, a duration that introduces significant carrying cost distress for average working-class sellers who relocate for employment purposes. The accumulation of these economic factors has resulted in an analytical dead end for the regional housing economy. Local wage growth remains firmly disconnected from historical property valuations. Institutional investors are actively withdrawing capital from the state, and municipal governments are trapped with underfunded infrastructure obligations. The stabilization mechanisms traditionally utilized by the state housing